Okay. My name is Karen August, and I'm the Business Development Representative for Next Generation Trust Services. Welcome to our joint webinar with Rockwell IRA. Scott Lefevre from Rockwell IRA is going to talk about common investments in the self-directed IRA market. What he's done will allow for questions, and I'll speak about what self-directed IRAs and alternative investments are. So whenever you're ready, Scott, take it away.
Okay, thanks, Aaron, and I appreciate people making the time. I know it's a commitment, and hopefully you'll learn something from the time you have. I'm going to try to do my part in a bit, shoot for 2025, and then we'll gather questions and also talk about again next generation after I'm done. But please, submit them, and we can also deal with those. So here to the goals for the day, or the goals for the time spent, and I went out today with a good view of self-directed IRA investment looks like in a TIC property. Some of you are with TIC properties or tenants in common properties. Others aren't. So I'm going to talk about that today and why we feel they make great sense for a self-directed investor, the right investor, looking for something that meets their strategy, and we'll talk about that as we go through that. So, joint tenancy versus tenancy in common. Those are two co-ownership terms that might not quite understand the differences. So I want to lay that out for you here and go through those very quickly. The picture on the side here says on a joint tenancy. Joint tenancy, there are multiple owners in a property. They all took possession, equal possession of that property. So they all have an equal share and a right to possess that property. They took that interest at the same time. So they put at the front end, nobody came in later, and those people in that property each own a share. And if one dies, they don't pass it on to their estate. Ownership goes to the other owning the property. So you can see the 5432. There's still, if one gets out or leaves or stage left, other own that right of survivorship in that. So they often talk about PITT, common possession, interest, time, and title. That is joint tenancy. Now the difference between jointly and tenants in common. Tenant common, sometimes called tenancy in common, but or I talked about it is a form of co-ownership. Concurrent, the government lets investors, 35 investors in property, but don't need to be equal amounts at all. They don't have to come in at the same time. They can ownership as they wish at any time, but ownership does survive or go with their estate, and they can pass that on to their estate. So really, a piece of the pizza, we like to say. Choose the size of pizza you want. You purchase that, you get a fee simple warranty for that, ownership for that, and you now have the opportunity to own some instant real estate without owning the whole property. So you really do own your pie and do with it what you want. The history of the TIC owner started back in the 1600s in England. It gave the opportunity for a commoner to own land. They couldn't themselves, so they came together and they became tenants in common in a certain property. They land and had their agreements between them, but they were able to buy that big plot or piece of property and be more productive as tenant common. And that the institutional grade opportunity for investors today in today's real estate is based off the same thing. It gives them an opportunity to be involved in a bigger project that they have an interest in that they might not be able to get in individually. Facts are true and real, and we'll just put them out there for people to understand, and most people know this, but obviously they're not as liquid as stock or mutual funds. They are real estate. About some of the difference between the different ticks as we go. Some are state plain and full, and some are ties, but we'll talk about that. But ticks is a umbrella. Then a lot of different things. A timeshare is a tick. Shared ownership in a property. Now, their usage rights and how they work. Obviously, there's conditions, but that's just kind of gives you a commercial property. What we're going to talk about today, a single tenant, probably a medical building or a clinic. Kind of properties obviously are much different than a time resort, but there's different reasons to own them. So investments are often tax driven, and some aren't. Some are just for creation or so we're going to talk about, but just understand that tenant in common is an undivided fractional interest in a property. You have co-use or not co-use rights. Excuse me for that voice here. So on the real estate ownership, this allows people to age in this property is and lean that way is because there's no to no management. Now, use a picture of the guy with the headache. That's usually the landlord that managing properties or fixing toilets or getting calls late at night. The nice about a TIC ownership is most often you aren't in that position. You have very passive involvement in the property. Another is it helps you diversify your portfolio, reduce the risk. We tell all the time that you wouldn't put all your money in this either. There's good investments across the board and investments to match your strategy. We think real estate in a self-IRA makes great sense, and we think that TIC properties in a self-directed IRA also make great sense. So there are these that come with and without debt. Rockwell, again, this isn't a sales pitch for Rockwell, but we focus on properties without debt. So you don't have the bank or the creditor standing your head while you're trying to figure out and collect rents from the tenant. That is something that we don't weather the economic storm because of that, because we didn't have leverage hanging over us. Other times which can be effective and make sense for the investor, but they need to know what into and what their strategy is. And another thing about TIC ownership too is the due diligence is more likely and often been done in a very complete and comprehensive way, so that having to go out and kick the tires of one of these buildings or properties respond that and has made a good package for you to help you make your decision. Now, it's interesting when you look at the bottom. 35% of real estate owners wish they could get rid of their headaches and get into a passive investment. So the type of people TIC property really makes sense for as well. Again, you share of that property. You also get that equal share, prorated share of the tax benefits, appreciation, depreciation. Now, within a self-directed IRA, depreciation thing is treated a little different, obviously, because you're already getting tax benefits on or maybe on tax deferral or tax free. So you would look to an advisor or a custodian for a little bit more information, but your financial tax advisor will give you information on that. And this is my plug here. You'll see a tick is related to a 1031 exchange, and a couple why, and then we'll go to IRA. But you're going to see this, and it's the amount, the piece of the pie is whatever you choose to buy. There are minimums, but really there's a flexibility in that amount that can be invested, and that's somebody's not having to go out and find the dollar amount that they have to buy or buy up. They can take everybody that they got out of one property and move it to a 1031 exchange into a TIC property. So that was for them, and then we talked about the burden of management. They're tired of that, and they want to move to something a little bit easier. Those benefits apply directly to self-directed IRAs. So real quickly, picture says a lot, but the headaches, if that's not for you, you can go a TIC property. Again, various types of TIC properties. What we're focusing on here is single tenant, triple net, long, very conservative, solid, finally sound investments. Others might put their investment money into flipping houses. That's obviously more aggressive and more risky, and because of the high risk, there can be a higher reward, but at the same time, is a very active role in that. The right investor, that makes sense, and others not. So, hypothetically, this is just a model. Really, what is comparing the value of a duplex purchased as a straight investment, triple net TIC. I'm not going to go through the math. The things really that you need to look at when you're looking at a TIC are that you're at 100% occupied on a single building, or you're zero. And so when you look at a TIC, obviously you're looking at the strength and the power of the tenant, length of the lease. We'll talk about it in a minute, but hopefully always got and can plan for, hey, at least 10, 15, 20 years out, 100% occupancy. Again, I have that, but in a normal duplex or like family property, you just factor in that it's never going to be 100%. You're going to be getting renters in and out. You're going to have a low occupancy. So that's one of the things that eats away at that. The other is on a triple net lease is the property taxes, insurance, maintenance, that's covered by the tenant. So not out of your pocket as an investor, where side it may be. You put those key or even four key things together, and you see that at the same rents, but model, same rent income, or top line, at the bottom line, you eliminate those triple net fees, and you also eliminate the vacancy factor. So everybody can make numbers, look what they want, and the various properties are various different things. That highlights in the red the two differences in occupancy and the triple net factors. So triple net single tenant lease makes sense for a lot of people. Obviously, real estate, and I think most people in business would concur that that's the most common self-directed investment in the IRA. Volatility, I'm in it with you. I don't like it. That's a portion of my portfolio in there, and that makes me feel uncomfortable, and it makes a lot of people feel uncomfortable. So those are some of the things that you can steer away from or diversify away from with a well-rounded portfolio. What's not, and this is very specific to self-directed IRAs, those people that that self-directed IRAs, there's key things there that every time you look at one, you ought to be aware of, and that is disqualified parties and prohibited transactions. Parties is really you and your familial line, linear up and down. So your parents, your kids' spouses, your spouse, and Karen can talk about that further. Those are disqualified, meaning you can't do something or somebody in that line that attaches to your IRA because it says no, that's hands off. You know, it's funny because you can go farther up and brothers and sisters and uncles and aunts and it changes, but a type of property is your tenant is in no disqualified party because they're not your family. You're usually leasing to a reputable, or should leasing to a reputable national or regional company with some good staying power and good history. So get in trouble that way unless you really look for trouble. Disqualified parties because you're hands off and they're doing their lease and you don't need to get near the building. The other is the prohibited transactions, and that's the hands off. Go into a Walgreens or a pharmacy or whoever's leasing your property and starting on the toilet. If you're a TIC owner in that property on this condition, they're paying their own property managers to do that. No rights to do that, and have no rights protects you against lifting the hammer because you can disqualify your entire IRA by working on a investment property. This prevents that. So those are some ways to keep you even remind you to stay at bay and not get into with your IRA regulations. And again, usually it's a long-term lease, long-term renewals in place, and all I'm talking about is tax-deferred tax benefits. Seriously consider, if you're an investor looking at a TIC property, long net model. That is, and another whatever we could go deeper on triple net versus absolute net, but again, it can move your liability of expenses to it, all the better. New construction, modelings, in fundamentally sound markets, and even within those markets, great locations within that market. What part of town is growing? What part of where's the building going on and stuff. So those to look at. The tenant quality. Is there a corporate guarantee? You know, our tenants that we work with and you know, they provide a corporate guarantee. So they might have multiple clinics or properties around the country. You know, if one suffers or is having an issue, they will guarantee. Now that doesn't guarantee that you don't have risk, and that doesn't guarantee that a company may not go out of business. Because if you're thinking there's no risk in investments, you're wrong. But we take, and others should take those a look at those options and give you as much protection as you can against that. And again, going back to the history of that tenant. Companies, great recession or as recession-proof as possible because people need done even in recession. So look for the tenant. Look, see if it's you know, bagel product on the market and bagels go south and donuts come in, you might be in trouble. But if you're a tenant that does things that the right way, then there's staying power there. Look at your sponsor. We'll talk in a second, but putting this together and offering it, what's their history, what are their references? Look at exit options and look at the effects of debt on the property, whether there are or not leverage on the property. strategies. We talk about it. It's not like getting out of a stock or bond, but it is the right program to move the properties. And it's funny when people ask us that, because this type of investor is in it for the long haul. Like though, we that 2% of these that have worked with us over a decade have gotten out, and the 98% are holding the properties as that. And about how they dealt with that when they did get out. But it's not a house flipping idea here. This is for the long term, and for that precious money that they've had in retirement plans and keep safe. Others that are common in the industry and in the agreement are take co-owners in the property to agree to sell the entire property, unanimous decision. Usually government says that you have up to 35 owners. We typically have 10, 12 owners in a property, and that seems to work very comfortably, and that's just kind of how the average works out in the type of property that we deal with. But if you're in a group and you're not meeting, you're not really getting together with that group, you're hands off until you need to be, and then you're working with your third-party property manager to decisions or be updated and get your rent payments and your tax papers. But in that, you got the property and you're flying solo and you're not dependent on anybody else there. Then the other owners have a first right of refusal to buy out, and that's a great benefit. If that doesn't, and nobody in that property will take keep your ownership out and buy it, which a lot of people do that, and do some right to help. Then a sponsor could also go out to kind of their secondary market or other buildings they've sponsored and other investors they've had and offer that. The product or the property manager that of our properties, and again we're out of it at that point, but that works with the investors, they can go to investors in 55 other properties they've done with us and put it out there to them. And I'll tell you, the 2% that did out were provided with getting out through the Rockwell family. So no matter what, sponsor, kind of look at that and see what the exit strategy is and what's available to you to get out and move the property. But a flip and turn or a 2 or 3 year, double your money investment, it's just real quick. And this relates back to the 1031 exchange. The government allowed TICs to be or 1031 money to be invested in TIC back in 2002, and they had conditions, 15 different criteria. We taught most of them. Limit the number of owners. It's a tenant in common ownership, voting rights, etc. And proceeds of a sale shared proportionately. All in there is that those same points apply to a self-directed IRA. So it's the element of TIC that makes sense for them. We'll go right to here and just here real quick. The difference there are, and you'll see questions out in the market, whether it's real estate TIC or a securities TIC. Often securities TIC or a REIT or something where the money is pooled, the funds are pooled, and managers or sponsors of that fund, they go out and they one or multiple properties, and you have a share of that, but you don't have own and fee simple title like you would the other way. And then I'll take TIC sponsorship. That's really where we can work with CPAs and other folks that can assist and sell these properties. They can a referral fee. We don't pool funds. We buy the property up front and then we sell it, and we don't manage that ownership. We turn it over to a third-party manager who have every right to hire another one. But we've worked with the same one for years, and they manage all those properties that go. Relationships are solid and good, and where on a tick or securities tick, again, they the property management, they cannot work through a referral fee. They market their product through brokers and others as a security. So quite right, and you'll hear both sides of that presentation and argument. We stay in the real estate tick sponsorship world. Words of wisdom. Alternate asset investors need to be vigilant, be responsible about what they're getting into, and that's why it's called self-directed. Beware of those prohibited transactions and disqualified person rules that we talked about. You don't want to get stung on the tax side. Then the disclaimer for any investor that is go make sure that your questions are answered by the proper advisor. Custodians can give you certain information, and then restricted also in certain things that they can do. So your attorney, your CPA, your advisors, look for people that can help you out and help you make smart decisions. The presentation tonight, I appreciate your time, and I can, anything that's come, I'm going to turn the control and to Karen so she can talk to you about next generation trust.
Do you have any questions for Scott?
No question.
No? Okay, cool. All right, I will take control back. Oh, didn't want to do that. Mm-hmm.
Thank you.
Okay. All right. So self-directed retirement plans. So this is just an introduction to the basics of investing in non-traditional assets within your retirement plan. Just like Scott spoke about, TIC, great way to use a non-traditional asset to invest into your retirement plan. So Generation Trust, we're a third-party administrator, so we're not a bank, we're not a financial planning service, we're a fiduciary. We have local professionals with experience and expertise as administrators and record keepers for self-directed retirement plans that allow our clients to invest their retirement funds into all allowable types of assets. We never endorse, recommend, sell any products or investments. We don't give investment advice. Just an educational resource for our clients and their advisors so they'll be educated on non-traditional investment options that they can put into their retirement plans so that their portfolio can be diversified. We don't review the merits or legitimacy of any investment. Services generation were recommended by any such third party. We're not in any way affiliated with them, or they're not. Like I said, we're not a fiduciary as defined in the IRC or any applicable federal state or local laws. So all of this is for educational purposes only. We love to educate people on self-directed IRAs because about 1% of the total population truly understands what a self-directed IRA is. So, self-directed IRA. It allows you to invest in non-traditional assets using your retirement plan funds. Investments into non-traditional assets, they've been around since the beginning of IRA accounts. So I think that this is just something new. They've always been around. Investments are kept. Keep your funds tax advantaged, just like IRAs. It's no different. And, establishing an account with like us, open the whole world.
Do I need to do anything to send that your way?
Nope, all Scott. Can you?
No, can't.
You,
I don't see it. It says Next Generation Trust Services and your phone number and joint webinar. There's no slides coming up.
No, I can do that. Aha. All right.
There.
Yeah. All right. Okay. Now I can see it.
There you-
Yes.
Yeah.
That's
Cool.
Thank you.
All right. So like I said, establishing an account with Next Generation, it opens up a whole new world of allowable investments that you can have in your self-directed account. So plans that can be self-directed, a traditional IRA for tax-deferred investing, a Roth for tax-free investing, a separate for self-employed individuals, a simple for small businesses that only have a handful of employees, employee qualified plans such as 401ks, portions can be self-directed as well. Education savings accounts and health savings accounts can also be self-directed. So we have a couple different options to fund your account. You deposit personal funds into your account. You can make your annual contribution. You can transfer from an existing IRA to a self-directed IRA or from an existing Roth IRA to a selected Roth IRA. If you roll over funds, you would be moving funds between unlike accounts. I mean that if you have a 401k from a previous employer, you're rolling over those funds, or had about in your company where they bought the pension plan out and then they physically gave you share, then you roll those funds into a self-directed IRA. You can also make a conversion so you can move funds from a tax-deferred account to a Roth so that the tax benefit. 2015 maximum contribution chart. For traditional and a Roth, the annual contribution is $5,500. If you're age 50 or older, you can contribute an extra $1,000, so you can contribute a total of $500 annually, and the rest of the contributions are there. And Scott was talking about prohibited transactions. There are restrictions on investments. There are qualified persons, the IRA holder, the IRA holder's spouse, and your descendants and their spouse. Cousins, that kind of thing. If you move horizontally, those aren't disqualified. Any fiduciaries on the account are disqualified as partners and people providing services to the account. There are prohibited types of assets that you don't have in self-directed IRA. So you can have life insurance, you have any type of collectibles. Some people like to collect wine, They like to have a wine collection that is, or cars, antique cars that you cannot have in self-directed IRA, antiques, rugs, stamps, they're all from having a self-directed IRA. So, it opens up a whole other world, outside of stocks and bonds. This is a whole other world of things that you can possibly invest your self-directed IRA. Real estate, mortgage notes, limited partnerships, you invest in LLCs, you can invest in hedge funds, precious metals, joint ventures. It's an unlimited amount of things that you can use your self-directed IRA for. Before you invest, you have to make sure that you establish your self-directed IRA account for funds so that you have at least enough for a good faith deposit in generation account before you choose to invest in real estate. Because real estate deadlines can be tight. Our processing time is 2 business days. So once we have the completed application to get your account open, it's 2 business days before we would open your account. But the transfer process from a current custodian could up to 30 days. It depends on where the custodian is, and if they accept the fax, or the transfer, or if they need original documents, that take longer. That's why it says it takes up to 30 business days. So if a directed IRA is something that you're looking to pursue, it's certain that you have the account open and funded so that you can move quickly to those deposits on real estate. This is an example of how a real transaction would work. You would establish and fund your self-directed IRA, you get your investment property, negotiate the purchase contract in the name of the IRA. So next generation TS services, FBO for the benefit of John Smith, IRA, and then the IRA number. Submit the approved contract through Next Generation Trust with the deposit instruction. Next Generation would execute the contract and submit the deposit on behalf of your self-directed IRA. You have to do your due diligence, home inspections, title searches, all that. Submit all the closing documents with escrow instructions to Next Generation. We would execute the closing documents and fund the escrow. Now your IRA owns the property. So all the income and the expense for property would flow in and out of your directed IRA. And to extend a tax lien, you locate the tax auction that you would be attending. You would give us the backup information. Ready auction in the name of the self-directed IRA. Fill out all the purchase documents, indicate check denominations. I'm going to bring to the auction. Next Generation will execute the documents and send you the check. Client will go to the tax lien auction, bid as normal. Client will pay with the funds sent from the IRA. And then if there's any unused funds, they would go to the IRA. I have a couple examples for private placement, but if you need more information on self-directed IRAs, or if you have an IRA and you're interested in opening a self-directed one, our site is up there. My email is there. The phone numbers. If more information, don't hesitate. Anybody have any questions?
Where are you located? Can you hear me?
Yes.
Do you hear him?
It's okay, right?
No, where are you located?
Are we located? We are in northern Jersey. Jersey?
The state?
Yeah.
Okay. Thank you.
No problem. But we have clients all over the country. We are a small office, but we do pride ourselves on excellent customer service. So. Well, thank you for attending our webinar. I said if you want more information on Rockwell or you want more information from Next Generation, we had our websites up there. Don't hesitate to reach out to us.
Thank you.
You guys' information. Thank you.
Thank you.
You're welcome. Thank you for attending.
All right. Good night.
Bye-bye. Thank you.
Bye.
Oh, thank you, Scott.